Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. The world of crypto investing offers both exciting potential and significant challenges. It's a relatively new market, known for sudden growth spurts but also for unexpected drops. Many are drawn to the chance for big gains, yet it's important to understand the risks involved. This introduction sets the stage for a closer look at what makes crypto investing unique. We'll explore the opportunities that draw so many in, along with the pitfalls that every investor should know about before diving in. Understanding the volatility of cryptocurrency markets. Cryptocurrency markets are known for their dramatic price swings. One day, a coin might see a huge jump. The next, it could experience a sharp drop. What exactly causes these sudden shifts? It's a mix of different factors, from public mood to market structure and even new government rules. Understanding these elements can help you better grasp why crypto prices behave the way they do. Let's look at the main reasons behind this constant movement. Market sentiment and speculation. Have you ever noticed how a popular tweet or a news story can send a crypto's price soaring or plummeting? This is market sentiment at play. News, social media chatter, and the opinions of influential figures can drastically affect crypto prices. When everyone gets excited about a new project, they rush to buy, pushing prices up rapidly. Conversely, negative news or a well-known personality expressing doubts can trigger widespread selling, leading to quick price declines. This often creates a herd mentality, where people follow the crowd without fully understanding the underlying reasons. This can lead to moments of irrational exuberance, where prices rise beyond logical valuations, or panic, causing rapid drops. Liquidity and market cap considerations. Not all cryptocurrencies behave the same way. Think about it like this. Selling a popular stock is usually easy because many buyers are waiting. The same goes for large cryptocurrencies. Bitcoin and Ethereum, with their massive liquidity and high market caps, tend to have more stable price movements. You can buy or sell large amounts without significantly impacting the price. However, smaller altcoins often have much lower liquidity. This means there are fewer buyers and sellers at any given moment. If someone wants to sell a large amount of a low liquidity coin, it can cause a significant price drop because there aren't enough buyers to absorb the supply. Similarly, a big buy can rocket the price up. Here's how market capitalization also plays a role. High market cap coins, like Bitcoin, require enormous amounts of money to move their price by even a small percentage. Low market cap coins can experience huge percentage gains or losses with relatively smaller amounts of money flowing in or out. This makes smaller cryptocurrencies much more susceptible to sharp, sudden price swings. Regulatory uncertainty and its impact. The legal landscape for cryptocurrencies is still evolving. Different countries have different rules, and these rules often change or are unclear. This regulatory uncertainty creates a sense of unease among investors. When governments propose new laws or announce crackdowns, markets often react strongly. For instance, if a major country announces a ban on certain crypto activities, it can trigger widespread selling as investors fear future restrictions. Conversely, clear and favorable regulations can boost confidence and lead to price increases. The constant shifts and lack of a unified global approach mean that regulatory news often becomes a major driver of market volatility. Key risks associated with crypto investments. Diving into crypto can feel like exploring a new frontier, full of exciting possibilities. Yet, just like any unfamiliar territory, it comes with its own set of dangers. Understanding these risks before you put your money in is crucial. We're talking about everything from cyber threats to unexpected legal changes and outright scams. Let's break down some of the main pitfalls you need to watch out for. Security risks, hacking and theft. When you invest in crypto, you become your own bank, which means you're largely responsible for your own security. Unfortunately, this also makes you a target for cyber criminals. Crypto exchanges, where many people buy and sell digital assets, are often targets for hackers. Think of them as digital vaults that criminals constantly try to break into. If an exchange gets hacked, your funds could be stolen, and getting them back is often a long shot. Personal wallets, whether they're software on your computer or a physical device, also need strong protection. A security lapse on your end, like clicking a phishing link or not using a strong password, can leave your crypto vulnerable. Decentralized finance, DeFi, protocols, while innovative, also face risks. Their code can have bugs or vulnerabilities that hackers exploit. Always remember, in crypto, your security practices directly impact the safety of your investments. Always use strong, unique passwords, enable two-factor authentication, and consider hardware wallets for larger holdings. Regulatory and legal risks. The rules around cryptocurrency are still taking shape worldwide. This creates a lot of uncertainty. Governments might decide to impose new taxes, tighten regulations, or even outright ban certain types of crypto or related activities. Imagine if a country where many crypto investors reside decides to make it much harder to buy or sell crypto. That could significantly impact market value. Different countries have very different views on crypto. Some are welcoming, while others are highly restrictive. What's legal and acceptable in one place might be forbidden in another. These shifting legal landscapes can create sudden and unpredictable impacts on your investments. Staying informed about regulations in your region and globally is very important, as compliance can affect everything from how you report your gains to whether you can even access certain services. Scams and fraudulent schemes. The crypto space, unfortunately, has a high number of scams. Because it's a relatively new and less regulated market, it attracts bad actors looking to trick investors. You'll often hear about rug pulls, where developers suddenly abandon a project and take investors' money. Pump and dump schemes involve groups artificially inflating a coin's price with false hype, only to sell their holdings once unsuspecting investors buy in, leaving others holding worthless assets. Then there are phishing attacks, which impersonate legitimate platforms to steal your login details or private keys. These schemes are designed to play on your desire for quick profits or your fear of missing out. Always be skeptical of projects promising guaranteed high returns. If something sounds too good to be true, it likely is. Always do your own research before investing in any project, no matter how exciting it sounds. Technological and operational risks. Beyond hacks and scams, there are also risks built into the technology and operations of crypto platforms. Blockchain technology, while robust, can still have bugs in its code. Smart contracts, which automate transactions, can also have vulnerabilities that criminals can exploit. If a major bug is found in a widely used blockchain or smart contract, it could lead to significant glitches or even loss of funds. Network congestion is another operational risk. During periods of high demand, a blockchain network can become slow and expensive to use. This means your transactions could take longer to confirm or cost more in fees. Lastly, exchanges and other crypto platforms can suffer from their own operational failures, like server outages or technical issues. These problems, while not a direct hack, can make it impossible for you to access or sell your assets when you need to, potentially leading to losses if prices are falling. Untapped opportunities in the crypto landscape. Beyond the risks, the crypto space holds incredible potential for growth and innovation. While volatility is a real factor, understanding the underlying technology and its broader applications reveals a world of exciting opportunities. We're talking about more than just speculative trading. We're looking at how blockchain is fundamentally changing industries and creating new ways to build wealth. Disruptive innovation and growth potential. Blockchain technology is much more than just the engine behind cryptocurrencies. It is a powerful tool revolutionizing industries far beyond finance. Think about how businesses track products from creation to sale. Blockchain can make supply chains transparent and efficient, reducing fraud and improving trust. For example, imagine tracking organic produce from the farm to your table with undeniable proof of its journey. In gaming, projects known as GameFi are allowing players to truly own in-game assets, trade them, and even earn real income through playing. This fundamentally changes the relationship between players and game developers. Digital identity is another compelling area. Blockchain can give you more control over your personal data, making online interactions more secure and private. Projects solving these real-world problems often have strong long-term growth prospects, as their utility extends far beyond market hype. Understanding the risks is just the beginning. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.